There is a ghost that haunts Wall Street. It doesn't rattle chains or whisper in the dark. It operates in the bright, cacophonous light of the trading floor, on the glowing screens of a million retail investors, and in the hushed, wood-paneled boardrooms where fortunes are decided. This ghost is the incessant, deafening roar of other people's opinions. It's the voice that tells you what to buy, when to sell, what to fear, and what to covet. It is the architect of bubbles and the catalyst for panics. It's the force that ensures the vast majority of people who attempt to build wealth in the market will fail, not because they are unintelligent, but because they are listening to the wrong voice. They are living by what we call an outer scorecard, measuring their success and their intelligence by the applause or the condemnation of the crowd. They buy a stock not because they understand its intrinsic value, but because it's the talk of the town, because it makes them feel smart at a dinner party. They sell a solid company in a panic, because the headlines are screaming apocalypse, because they can't bear the thought of their neighbor seeing their portfolio in the red. This is the path of the 99%. It is a path paved with anxiety, FOMO, the fear of missing out, and, ultimately, profound disappointment. But there is another way. There is a mindset, a quiet internal fortress of conviction that renders the ghost of public opinion powerless. It is the single greatest weapon in the arsenal of the world's most successful investor, Warren Buffett. He calls it living by an inner scorecard. This is not a stock-picking trick or a complex algorithm. It is a fundamental rewiring of your mind, a shift in your source of validation from the external to the internal. It is the conscious decision to measure yourself by your own standards, your own research, and your own principles, regardless of what the world is screaming. It is the source of independent thinking. It is the key that unlocks the ability to be greedy when others are fearful, and fearful when others are greedy. And it is the only true path to generating superior long-term results and achieving lasting financial freedom. Today, we are not just going to talk about this principle. We are going to deconstruct it piece by piece and build a blueprint for you to forge your own inner scorecard. We will journey through the defining moments of a legendary career, explore the deep psychological traps that ensnare most investors, and lay out a practical framework for decision-making that will insulate you from the madness of crowds. This is the beginning of your transformation from a market participant, tossed about by the whims of the herd, into a true investor, guided by an unwavering internal compass. Our journey begins not in the high-stakes world of corporate takeovers, but in the quiet, formative years of a young man from Omaha, Nebraska. This is where the foundation was laid, where the very first lines of an internal constitution were written. This is the genesis of conviction. To understand the inner scorecard, you must first understand its author. Warren Buffett's foundational anecdote isn't a single dramatic trade. It's the story of his intellectual apprenticeship under the father of value investing, Benjamin Graham. After being initially rejected from Harvard Business School, a stroke of luck he would later celebrate, Buffett discovered that Graham, the author of the seminal text The Intelligent Investor, was teaching at Columbia Business School. For Buffett, this was like a devout musician learning he could study directly under Mozart. He enrolled immediately. The world of finance in the late 1940s and early 1950s was a very different place. It was a world of tips, rumors, and chart-gazing. The dominant ethos was speculative. Wall Street was a grand casino where the game was to guess which direction the crowd would run next. The outer scorecard was king. Your success was defined by how quickly you could jump on a hot trend and how much applause you got for it. But inside Graham's classroom, a different gospel was being preached. Graham taught that a stock was not a squiggly line on a chart or a lottery ticket. It was a fractional ownership of a real business. This was a revolutionary idea for many. He taught that the market was not a wise, all-knowing entity, but a manic-depressive business partner he personified as Mr. Market. Some days, Mr. Market would be euphoric, offering to buy your shares at ridiculously high prices. On other days, he would be despondent, offering to sell you his shares at absurdly low prices. The intelligent investor, Graham argued, was not someone who listened to Mr. Market's mood swings. The intelligent investor was someone who ignored him, except to take advantage of his irrationality. You did not ask Mr. Market for his opinion. You waited for him to offer you a bargain. This was the core of Graham's philosophy. You calculate the intrinsic value of a business, what it's actually worth based on its assets and earning power, and then you wait patiently until the market offers you a price that is significantly below that value. He called this the margin of safety. For Buffett, this wasn't just an investment technique, it was a complete worldview. It was a declaration of independence from the tyranny of market opinion. It was the blueprint for an inner scorecard. The score was no longer, did the stock I bought go up today? Or do my friends think I'm smart? The score was now, did I correctly calculate the intrinsic value of the business? And did I buy it at a significant discount to that value? That's it. That was the entire game. If you did those two things correctly, the day-to-day fluctuations of the stock price were nothing more than the meaningless ramblings of a lunatic. Your success was determined at the moment of purchase, based on the quality of your own analysis, not by the subsequent validation of the market. After graduating, Buffett went to work for Graham's firm, Graham-Newman Corp. Here, he saw the philosophy in action. He spent his days poring over financial manuals, hunting for what Graham called cigar butt stocks, unloved, ugly businesses that were trading for less than their net working capital. They were like discarded cigar butts on the street that had one free puff left in them. They weren't glamorous, they would never be the talk of a cocktail party, but they were mathematically demonstrably cheap. They were a win, according to the inner scorecard. During this time, Buffett learned a crucial lesson that would define his entire career. He saw that even his mentor, the great Ben Graham, was not entirely immune to the pressures of the outer scorecard. Graham had a strict rule against getting too involved with the management of the companies he invested in. But in one particular case, a company called Western Insurance, Graham made an exception and got drawn into a proxy fight. The battle became public and messy. While it ultimately worked out, Buffett observed the immense emotional and mental energy it drained from his mentor. He realized that the purity of the inner scorecard could be compromised not just by market opinion, but by ego and the desire to be proven right in a public arena. When Buffett left Graham-Newman in 1956 to return to Omaha and start his own investment partnerships, he took Graham's core principles and refined them. He made a conscious decision to structure his life and his business in a way that would insulate him from the noise. He didn't set up shop in New York City, the epicenter of the outer scorecard. He went back to Omaha, where he could think clearly, away from the constant chatter of Wall Street. He communicated with his partners through letters, not frantic phone calls. He laid out his principles clearly from the start. He would not tell them what he was buying or selling, and he asked them to judge him not on any single year's performance, but over a period of at least 3 to 5 years. He was systematically dismantling the mechanisms of the outer scorecard and forcing his partners and himself to live by the inner one. This period, from his time at Columbia to the early days of his partnerships, was the crucible in which his mindset was forged. He wasn't just learning a method for stock picking, he was building a philosophy for decision-making. The score was kept internally. The validation came from the rigor of his own analysis. The success was measured by adherence to the process, not by the short-term whims of the market. This foundational story is crucial because it shows that the inner scorecard isn't something you're born with. It is built, it is learned. It is a conscious choice to adopt a different set of rules for a game that everyone else is playing by sight and sound. Buffett chose to play by a set of internal, mathematical, and logical principles, and in doing so, he made the ghost of public opinion irrelevant. The reason Buffett's inner scorecard is so powerful is because it serves as a shield against a host of deeply ingrained psychological biases that sabotage the average investor. The human brain is not naturally wired for successful long-term investing. For millennia, our survival depended on our ability to quickly react to social cues, follow the herd, and avoid being ostracized. Sticking with the tribe meant safety. Venturing out alone was perilous. This ancient wiring manifests today as a series of cognitive biases that make the outer scorecard feel not just alluring, but correct. The most dominant of these is social proof, or what is more commonly known as herd mentality. This is the tendency to assume that the actions of others reflect the correct behavior for a given situation. If everyone is running out of a burning building, it's wise to run with them. If everyone at the office is raving about a new tech stock, our brain tells us they must know something we don't. The desire to conform is a powerful primal urge. In the world of investing, this leads to chasing momentum. When a stock is soaring, and financial news networks are celebrating its unstoppable rise, the social proof is overwhelming. Every headline, every conversation with a friend, every uptick on the screen confirms the narrative. Buying that stock provides an immediate psychological reward, a feeling of being in the know, of participating in a shared success. You feel smart, you feel validated, you have scored points on the outer scorecard. The flip side is equally destructive. When a market panics and everyone is selling, the social proof is just as powerful. The instinct is to sell too, to join the herd in its flight to safety. Holding on, or even worse, buying, feels profoundly wrong. It feels like standing still while a stampede thunders towards you. Your brain screams that you are being a fool, that the crowd must be right. Resisting this urge requires a deliberate, conscious override of a fundamental human instinct. This is a core function of the inner scorecard. It provides an alternative, logical framework to consult when your instincts are screaming at you to follow the crowd. Closely related to social proof is a phenomenon known as authority bias. We are conditioned to defer to the judgment of experts and authority figures. In the financial world, these are the well-dressed analysts on television, the authors of market newsletters, the so-called gurus with large social media followings. When they declare a stock a strong buy or predict a market crash, their pronouncements carry an immense weight of authority. The retail investor, feeling a lack of expertise, outsources their decision-making to these figures. The problem is that these authorities are often wrong, and, more importantly, their incentives are rarely aligned with yours. They are often in the business of generating clicks, views, and trading commissions. They thrive on bold predictions and creating a sense of urgency. The inner scorecard is a declaration that you are your own primary authority. While you may listen to others for information, the final decision-making authority rests with your own research and your own established principles. You trust your own deep analysis of a company's financial statements more than a soundbite from a television personality. Another critical bias at play is what psychologists Daniel Kahneman and Amos Tversky identified as loss aversion. Their research showed that for most people, the psychological pain of losing a certain amount of money is roughly twice as powerful as the pleasure of gaining the same amount. This creates a deeply irrational approach to risk. It's why people will hold on to a losing stock for far too long, praying it will get back to what they paid for it, because selling would mean crystallizing the loss and admitting a mistake, a major blow on the outer scorecard. Conversely, it's why they often sell their winning stocks too early. They want to lock in the gain and experience that feeling of pleasure, fearing that the stock might fall and turn a win into a loss. The inner scorecard reframes this entire dynamic. The focus is not on the short-term gain or loss of the stock price, but on the relationship between the current price and the company's intrinsic value. If a great company you bought at a fair price drops by 20% due to a market panic, the inner scorecard doesn't see a loss. It sees an opportunity. The business is still great, but now it's even cheaper. The correct action, according to this internal logic, is to buy more, not to sell in a panic to avoid the pain of a paper loss. It detaches the emotional sting of price volatility from the rational assessment of business value. Finally, there is the overconfidence bias, particularly the flavor of it that comes from recent success. When an investor makes a few good trades, especially in a bull market where almost everything is going up, it's easy to start attributing that success to skill rather than luck. This inflates the ego and makes them susceptible to taking bigger and bigger risks. They start to believe they have the hot hand. This is the outer scorecard in overdrive. They are lauded by friends, their account balance is growing, and they feel like a genius. This is precisely when they are most vulnerable to buying a popular, high-flying, and grossly overvalued stock, abandoning the disciplined principles that might have led to their initial success. The inner scorecard acts as a grounding mechanism. It constantly forces you back to the same set of questions. What is the business worth? Am I paying a fair price? Do I understand how this company makes money? It doesn't care if you've been right 5 times in a row. It forces the same rigorous, unemotional analysis every single time, acting as a crucial brake on the ego-driven decision-making that so often precedes a financial catastrophe. By understanding these psychological principles, we can see that the inner scorecard is not just a quaint philosophy. It is a sophisticated cognitive tool. It is a pre-commitment to a rational process, designed specifically to counteract the predictable, irrational, and wealth-destroying impulses hardwired into our brains. It is the operating system for independent thinking in an environment designed to encourage conformity. Translating this philosophy into action requires more than just understanding it. It requires a practical, repeatable process. This is the blueprint for building and using your own inner scorecard, a mental model that can guide your decision-making in the chaotic world of finance and business. The process can be broken down into 4 distinct essential steps: codification, research, valuation, and inaction. Step 1 is codification. You must write down your rules. An unwritten principle is merely a suggestion. A written one is a contract with yourself. This is the most crucial step, and the one most people skip. You need to create your own personal investment constitution. This document doesn't have to be long, but it must be specific. It should answer fundamental questions. For example, what types of businesses am I willing to own? This is your circle of competence. Will you only invest in businesses you can easily explain to a 10-year-old? Will you avoid certain industries like biotech or volatile commodities because you acknowledge you don't have an edge there? Be honest about what you know and what you don't know. What financial metrics are non-negotiable? You might decide, for instance, that you will only consider companies with a consistent history of profitability, a debt-to-equity ratio below a certain number, and a return on equity above 15%. These are your quantitative hurdles. Write them down. What is my required margin of safety? This is your core risk management principle, inherited directly from Ben Graham. Will you only buy a stock if it is trading at a 30% discount to your calculated intrinsic value? 40%? 50%? Define it. What are my selling criteria? This is just as important as your buying criteria. You might decide to sell only when one of 3 things happens. The company's fundamentals have seriously deteriorated, the stock has become massively overvalued relative to its intrinsic worth, or you have found a demonstrably better investment opportunity. By defining these rules in advance, you prevent yourself from making emotional decisions in the heat of the moment. Your written constitution becomes the ultimate arbiter, your inner scorecard made tangible. The second step is research. This is where you do the work that 99% of market participants are unwilling to do. This is the process of building your own conviction, independent of outside opinion. Pick a company within your predefined circle of competence. Your mission is to understand this business so well that you would be comfortable owning the entire company outright. Start by reading the last 10 years of the company's annual reports. Pay special attention to the shareholder letters written by the CEO. Is the language clear and honest, or is it filled with jargon and excuses? Does the CEO admit mistakes? This qualitative assessment of management is critical. Then, become a financial detective. Dig into the numbers. Don't just look at the income statement. Analyze the balance sheet and the cash flow statement. Is the company's revenue growth consistent? Are its profit margins stable or expanding? How much debt is it carrying? Most importantly, is it generating free cash flow, the lifeblood of any business? Your goal here is not to predict next quarter's earnings. Your goal is to understand the company's long-term competitive advantages, or what Buffett calls its moat. What protects this business from competitors? Is it a powerful brand, like Coca-Cola? A network effect, like American Express? Low-cost production, like Geico? A high cost for customers to switch, like Microsoft? This deep, Focused research is what builds the intellectual foundation for independent thinking. You stop seeing a stock ticker and start seeing a living, breathing business. The third step is valuation. After you thoroughly understand the business, you must attach a number to it. What is it actually worth? This is the process of calculating intrinsic value. There are many methods to do this, but a common and effective one for long-term investors is the discounted cash flow (DCF) analysis. The concept is simple. A business is worth the sum of all the cash it can be expected to generate in the future, discounted back to its present value. This forces you to think like a business owner. You have to project the company's future cash flows, based on your research, into its growth prospects and profitability. Then, you choose a discount rate, which is essentially your required annual rate of return, to translate those future dollars into today's dollars. The final number you arrive at is not meant to be perfectly precise. The goal is to be approximately right. As Buffett says, it's better to be vaguely right than precisely wrong. This calculated intrinsic value becomes the anchor for all your decisions. It is the North Star of your inner scorecard. When the market price is fluctuating wildly, you can look at your conservative, well-researched valuation and remain calm. The market price is noise. Your calculated value is your reality. The fourth and final step is perhaps the most difficult: inaction. Once you have your constitution, have done your research, and have calculated a value, the vast majority of your time should be spent doing nothing. You must wait patiently for Mr. Market, in his fits of pessimism, to offer you one of the businesses on your watch list at a price that is significantly below your calculated value, your predefined margin of safety. This might mean going months or even years without making a single purchase. This is excruciating for someone living by an outer scorecard, who feels the need to always be in the action. But for the inner scorecard investor, patience is a primary virtue. It is the ultimate expression of discipline. You know what you are looking for, and you refuse to swing at anything less than the perfect pitch. This four-step blueprint, codify, research, value, enact, is the practical application of the inner scorecard philosophy. It is a systematic process for replacing the emotional, reactive decision-making of the crowd with a logical, proactive, and patient framework. It is hard work. It requires discipline and a temperament that is comfortable with being lonely. But it is this very difficulty that creates the opportunity for superior results and is the only sustainable path for any retail investor aiming for true, independent financial success. To truly appreciate the power of the inner scorecard, we must spend time examining its opposite. We must walk the path of the 99%, the road paved with good intentions and littered with shattered portfolios. This is the world of the outer scorecard, and it is the default setting for almost everyone who enters the market. The journey for the outer scorecard investor begins not with a set of principles, but with a piece of noise. It might be a stock tip from a brother-in-law at a barbecue. It might be a company name mentioned repeatedly on a financial news channel. It might be a stock that's been soaring, filling the investor with a potent mix of envy and the fear of missing out. The initial motivation is not a deep understanding of a business, but a social or emotional trigger. The research phase for this investor is a shallow exercise in confirmation bias. They don't read 10 years of annual reports. They read the first page of Google search results. They look for articles and analyst reports that confirm their initial impulse to buy. They might glance at a stock chart and see that the line is going up, which they interpret as proof that it will continue to go up. They might see a high price target from a Wall Street analyst and feel reassured, without ever questioning the analyst's incentives or track record. They are not seeking to understand the business. They are seeking permission to pull the trigger, to join the party. They are looking for a story, a narrative that feels good. This company is changing the world, they'll say, often with little understanding of the company's actual financial health or competitive landscape. The valuation process is non-existent. The concept of intrinsic value is foreign. The only metric of value that matters is the last traded price. If other people are willing to pay a high price for it, then it must be worth it. The justification is circular. It's a good investment because the price is going up. They are buying price momentum, not business value. This is the greater fool theory in action, the belief that you can buy an overvalued asset because there will always be a greater fool willing to buy it from you at an even higher price. This works, of course, until it doesn't. When the music stops, the outer scorecard investor is left holding an asset they don't understand, which they bought at a price they can't justify. The act of buying is often impulsive, driven by a desire for quick and easy profits. The antithesis of patient inaction is frenetic activity. The outer scorecard investor feels the need to always be doing something. They check their portfolio multiple times a day. They listen to the daily market chatter trying to divine the next move. This constant activity gives them the illusion of control, but in reality, it just exposes them to more emotional decision-making and racks up transaction costs that eat away at their returns. But the real tragedy occurs when the tide turns. Because the purchase was not based on any fundamental conviction or deep research, there is no anchor to hold on to when the stock price begins to fall. The first 10% drop is met with anxiety. A 20% drop induces panic. The narrative that felt so compelling on the way up now seems flimsy and foolish. All the social proof that encouraged the buying now works in reverse. The headlines turn negative. The same brother-in-law who gave the tip is now silent. The television analysts are talking about a different stock. With no inner scorecard, no calculated intrinsic value to consult, the only available metric, the stock price, is screaming failure. The pain of loss, amplified by the social embarrassment of having made a public mistake, becomes unbearable. This is when they sell, often near the bottom, crystallizing a permanent loss of capital. They then swear off the market as a rigged casino, never realizing that the casino they were playing in was one of their own emotional construction. A perfect illustration of this path was the dot-com bubble of the late 1990s. It was the golden age of the outer scorecard. Companies with no profits, no revenues, and often no viable business plan were going public and seeing their stock prices multiply overnight. The social proof was immense. Everyone from barbers to dentists was a day trader. Quitting your job to trade tech stocks was seen as a savvy career move. To question the new paradigm was to be labeled a dinosaur, out of touch with the future. Investors were not buying businesses. They were buying concepts, stories, and tickers that ended in .com. They did no research beyond confirming that the company was involved with the internet. Valuation was a forgotten art. The justification was always, "This time it's different." The result was inevitable. When the bubble burst in early 2000, trillions of dollars in speculative wealth evaporated. The very same people who had felt like geniuses for buying Cisco systems at 60 times sales were wiped out, selling in a panic as the entire house of cards collapsed. They had outsourced their thinking to the crowd, and the crowd led them right off a cliff. This is the path of the 99%. It is a reactive, emotional, and ultimately self-destructive approach to investing. It is a constant search for external validation in an arena that is famously fickle and irrational. By choosing to live by the applause of the crowd, the outer scorecard investor cedes control of their financial destiny to the most unreliable narrator in the world, Mr. Market. The difference between these two mindsets is not merely philosophical. It manifests in stark, quantifiable financial outcomes. The direct financial connection between an inner scorecard and superior wealth creation is profound, impacting everything from individual stock returns to the overall performance and volatility of a portfolio. Let's trace the financial journey of a dollar invested through the lens of an inner scorecard versus an outer scorecard. The inner scorecard investor begins with a capital preservation mindset. Their first rule, famously articulated by Buffett, is never lose money. Their second rule is don't forget rule number 1. This isn't about avoiding all risk. It's about avoiding the permanent loss of capital that comes from overpaying for an asset. By demanding a margin of safety, buying a business for significantly less than its calculated intrinsic value, they are building a buffer against unforeseen problems or errors in judgment. This has a direct and powerful impact on the balance sheet of their portfolio. It dramatically lowers the downside risk. For example, if two investors both calculate a company's intrinsic value to be $100 per share, the outer scorecard investor, caught up in the hype, might buy it at $120, hoping it goes to $150. The inner scorecard investor, adhering to their 40% margin of safety rule, will only buy it if the price drops to $60 or below. If the market turns and the stock falls to $70, the outer scorecard investor has a massive 42% loss. The inner scorecard investor who bought at $60 is actually sitting on a 16% gain. This downside protection is the bedrock of long-term compounding. A single 50% loss requires a 100% gain just to get back to even. By systematically avoiding these catastrophic losses, the inner scorecard investor ensures their capital base is always preserved and ready to compound, rather than constantly trying to dig out of a hole. Next, consider the impact on returns. The inner scorecard focuses on the long-term earning power of the business, not the short-term momentum of the stock. By buying great companies at fair prices, they are harnessing the power of corporate compounding. A great business, one with a durable competitive moat, will increase its intrinsic value year after year as it reinvests its earnings at high rates of return. As the business becomes more valuable, its stock price will eventually follow. This is a much more reliable and less stressful source of returns than trying to guess the short-term psychology of the market. The outer scorecard investor is chasing fleeting price movements, while the inner scorecard investor is partnering with predictable value creation. This leads to a different character of returns. The outer scorecard investor's portfolio is often a roller coaster of high volatility, with huge gains in bull markets followed by devastating losses in bear markets. The inner scorecard investor's portfolio tends to be much more stable. Because they buy with a margin of safety, their holdings often decline less than the overall market during downturns. And because they are buying businesses with strong fundamentals, they recover more robustly. Over a multi-decade period, this lower volatility and steady compounding leads to vastly superior total returns, a testament to the fable of the tortoise and the hare. Furthermore, the inner scorecard has a direct impact on taxes and transaction costs, two silent killers of portfolio performance. The outer scorecard investor, with their frenetic activity of buying and selling, is constantly triggering taxable events and paying commissions or fees to their broker. These costs create a significant drag on performance year after year. The inner scorecard investor, whose favorite holding period is forever, is a paragon of tax efficiency. By holding their investments for many years, they allow their capital to compound tax-deferred. When they do eventually sell a winner, their profits are taxed at the much lower long-term capital gains rate. This patient, low-turnover approach can add percentage points to their annualized returns over a lifetime, a massive advantage that is often overlooked. We can see this quantified in the historical record of Berkshire Hathaway. Over decades, Buffett's adherence to these principles has produced a compound annual gain far in excess of the S&P 500. This wasn't achieved by making wild, speculative bets. It was achieved through the patient, disciplined application of an inner scorecard, buying wonderful businesses at sensible prices and then holding them for a very long time. The financial result is not just a larger number in an account, it's a quality of wealth. It is wealth built on a solid foundation of understanding and conviction, not on the shifting sands of public opinion. This leads to a level of emotional control and peace of mind that the outer scorecard investor can never achieve. They can sleep well at night during a market panic, secure in the knowledge that they own pieces of excellent businesses that will be worth far more in the future. This emotional fortitude prevents them from making the single most costly mistake in investing: selling at the bottom. The inner scorecard, therefore, is not just a tool for picking stocks. It is a comprehensive system for wealth management that directly translates into lower risk, higher long-term returns, greater tax efficiency, and profound emotional resilience. It is the financial engine of independent thinking. The greatest challenge to the inner scorecard does not come when things are quiet. It comes when the noise of the outer world is at its most deafening. It is during times of extreme market euphoria or panic that the discipline to ignore the crowd is most tested and most valuable. This brings us to the ultimate crucible for Warren Buffett's philosophy, the dot-com bubble of the late 1990s. This period serves as the quintessential foundational anecdote for resisting the siren song of the outer scorecard. As the new millennium approached, the world was gripped by internet fever. A narrative had taken hold that the old rules of business and valuation no longer applied. This was a new economy, and the only thing that mattered was growth, eyeballs, and a futuristic-sounding business plan. Companies that were little more than ideas were achieving market capitalizations in the billions of dollars. Barron's, a respected financial publication, ran a cover story in late 1999 titled, "What's Wrong, Warren?" The article chronicled Buffett's failure to participate in the technology boom. Berkshire Hathaway's stock was lagging the market badly. While tech stocks were doubling and tripling in a matter of months, Berkshire's value was stagnating. The outer scorecard was delivering a brutal public verdict. Buffett had lost his touch. He was a relic, a dinosaur whose folksy wisdom about moats and margins of safety was hopelessly outdated in this new digital age. The pressure was immense. His own shareholders were questioning him. The media mocked him. Young, brash tech investors who had been in the market for less than 2 years were being hailed as the new geniuses of finance. It would have been easy for Buffett to capitulate. He could have bought a few high-profile tech stocks just to show he got it. It would have silenced the critics and given his stock a short-term boost. It would have been a massive win for the outer scorecard. But Buffett's inner scorecard was not calibrated to public opinion. It was calibrated to his own principles, chief among them being his circle of competence. At the 1999 Sunday Valley Conference, an annual gathering of media and technology moguls, Buffett gave a now legendary speech. He didn't try to predict when the bubble would burst. Instead, he methodically laid out a long-term history of other transformative industries, like aviation and automobiles. He showed how, in almost every case, the initial speculative frenzy led to massive capital destruction for investors, even though the industries themselves did indeed change the world. He then calmly stated that he simply did not know how to value these new internet companies. He couldn't confidently project their cash flows 10 or 20 years into the future. Because he couldn't value them, he couldn't determine if they were selling at a discount to their intrinsic worth. And therefore, according to the rules of his inner scorecard, he could not buy them. It didn't matter if they went up another 100 or 500%. The decision was not based on their price momentum. It was based on his inability to understand their long-term business prospects. He chose to accept the temporary pain of looking foolish in order to avoid the permanent pain of losing money in a game he didn't understand. A few months later, in March of 2000, the Nasdaq index peaked, and the bubble burst with spectacular violence. The same high-flying stocks that had been the darlings of the market collapsed by 80, 90, or even 100%. The new paradigm was revealed to be the same old speculative mania dressed in new clothes. The geniuses of the new economy were wiped out. And Warren Buffett, the dinosaur, was vindicated. While the rest of the market was in ruins, Berkshire Hathaway's coffers were full of cash, ready to be deployed into the opportunities that the panic would inevitably create. This story is the perfect embodiment of resisting the outer scorecard. Buffett endured years of public criticism and underperformance, not because he was stubborn, but because he was disciplined. His sense of success was not derived from the market's applause, but from his adherence to his own time-tested principles. He was willing to look wrong in the short term to be right in the long term. The dot-com bubble provides a perfect case study in the behavioral science behind the outer scorecard's deadly allure. The psychological principles at play were not new. They were the same ones that have fueled every speculative bubble in history, from the Dutch tulip mania in the 1600s to the crypto frenzy of recent years. Understanding these principles is the key to building your immunity. The primary force at work was a powerful cocktail of social proof and a concept called narrative economics, a term popularized by Nobel laureate Robert Shiller. A contagious story had taken hold. The internet was changing everything, and any company associated with it was destined for riches. This narrative was simple, compelling, and spread like a virus. It was repeated on television, in magazines, and in chat rooms. Every time a new tech IPO soared, the narrative was reinforced. This created an overwhelming sense of social proof. If millions of other people believed this story and were getting rich from it, it must be true. To doubt the narrative was to risk being ostracized, to be seen as a Luddite who just didn't get it. This social pressure is incredibly difficult to resist. Our brains are wired to seek consensus, and when the consensus is that strong, it feels almost physically painful to stand against it. This was amplified by the envy/jealousy tendency, a powerful motivator that Charlie Munger, Buffett's longtime partner, often speaks about. Investors weren't just seeing numbers on a screen. They were hearing stories about their neighbors, their dentists, their kids, friends, parents, making fortunes overnight with seemingly no effort. Envy is a corrosive emotion that drives people to abandon all rational thought. The fear of being left behind, the ultimate FOMO, can compel even the most sensible people to take insane risks. They weren't investing based on a rational calculation of risk and reward. They were gambling in a desperate attempt to keep up with the Joneses. Another key psychological trap was the overconfidence bias, fueled by what is known as the recency bias. Because tech stocks had been going up, and only up, for several years, investors began to extrapolate this recent past into the indefinite future. They anchored their expectations to this recent performance, forgetting the long history of market cycles and crashes. Each successful trade they made reinforced their belief that they were skilled, not just lucky to be in the middle of a historic mania. This created a dangerous feedback loop. Rising prices created overconfidence, which led to more buying and even higher prices, which in turn created even more overconfidence. This is the classic anatomy of a speculative bubble. The inner scorecard serves as a direct antidote to these biases. It breaks the feedback loop. By forcing the investor back to a set of pre-codified, objective rules, it short-circuits the narrative-driven emotionalism. Instead of asking, "Is this story compelling?" the inner scorecard asks, "What are the cash flows? What is the valuation?" It replaces the social question, "Is everyone else buying this?" with the independent question, "Do I understand this business, and is it cheap?" Buffett's refusal to invest in tech stocks was not an emotional reaction. It was the logical output of his internal system. The input was, quote, 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 "tech company with unpredictable future earnings." The process in his brain ran it against his circle of competence rule. The output was, "do not invest." The screams of the outer world were irrelevant to the calculation. To build this immunity, one must actively practice what psychologists call decoupling, the ability to separate an emotional response from a cognitive evaluation. When you feel the pull of envy or the fear of missing out, you must train yourself to recognize it as a purely emotional, biological signal. You acknowledge the feeling, but you do not let it drive the decision-making process. You decouple the emotion from the action and instead route the decision through your rational, pre-committed framework, your inner scorecard. This is a mental muscle that must be developed through conscious practice. By studying past bubbles and understanding the predictable patterns of human psychology, you can learn to recognize the symptoms in real time and protect yourself from joining the doomed herd. How, then, do you build a practical defense system against the intense psychological pressure of a market mania? The blueprint for resisting the outer scorecard requires constructing a fortress of habits and mental models before the storm arrives. Waiting until the bubble is in full swing is too late. Your emotional defenses will be overwhelmed. Here is a step-by-step guide to building that immunity. First, you must publicly and privately commit to your identity as an investor, not a speculator. This is a crucial framing device. A speculator buys something hoping its price will go up. An investor buys a business based on its ability to generate cash over the long term. When you are offered a hot tip, your pre-programmed response should be, "That's interesting, but I'm not a speculator, I'm a business analyst. Let me see the company's financials." This identity statement acts as a powerful first line of defense, short-circuiting a conversation about price momentum and reframing it around business fundamentals. Second, you must create an information diet. The outer scorecard is fueled by a constant stream of low-quality, high-emotion information from financial media. You must be ruthless in curating your inputs. Unfollow market gurus on social media. Turn off the financial news channels that thrive on hype and fear. Their business model depends on keeping you agitated and active. Instead, replace that noise with high-quality, long-form content. Spend your time reading annual reports, industry journals, and biographies of great investors and business leaders. Your goal is to fill your mind with the slow, deliberate thinking of business ownership, not the frantic, short-term chatter of a trading desk. This is the informational equivalent of choosing to eat a healthy, home-cooked meal instead of binging on junk food. Third, create a to-don't list. Just as your investment constitution codifies what you will do, a to-don't list codifies the specific, tempting behaviors you will avoid. This list might include: I will not buy a stock on the day I first hear about it. I will not check my portfolio more than once a week. I will not invest in any company whose business model I cannot explain simply. I will not make an investment decision based on a media headline. This list serves as a behavioral circuit breaker, forcing a pause and a moment of reflection before you engage in a potentially destructive, impulsive action. Fourth, implement a mandatory waiting period. This is a simple but incredibly effective technique for defeating impulsivity. Make a rule for yourself. From the moment you decide a stock is a potential buy, you must wait a fixed period of time, say 72 hours, before you are allowed to execute the trade. This cooling-off period allows the initial emotional excitement to subside and gives your rational mind a chance to reevaluate the decision. Often, the investment that seemed like a stroke of genius in the heat of the moment will look much less appealing after 3 days of sober reflection. This simple rule single-handedly prevents a huge number of mistakes driven by the fear of missing out. Finally, find a quote-quote rationality partner. This is not just any friend, but someone who understands and respects your investment philosophy. Their job is not to give you ideas, but to act as a sounding board and hold you accountable to your own rules. Before making a new investment, you must explain the thesis to your partner, articulating exactly how it fits with the principles in your written constitution. The simple act of explaining your reasoning out loud to a skeptical, friendly audience can instantly expose flaws in your logic. Your partner's primary question should always be, is this decision consistent with your inner scorecard, or are you being swayed by the noise of the outer scorecard? This external accountability is a powerful bulwark against the silent creep of emotional bias. By implementing these 5 practices, adopting the investor identity, curating your information diet, creating a to-don't list, enforcing a waiting period, and using a rationality partner, you are not just hoping to resist the outer scorecard. You are building a systematic, multi-layered defense system. You are constructing an environment for yourself where rational, independent thinking is the path of least resistance, and emotional, herd-like behavior becomes difficult and unnatural. This is how you transform a noble philosophy into a lived, durable reality. The contrast between the path of the inner scorecard and the path of the 99% during a bubble is not just a matter of who feels smarter at the end. It is a story of catastrophic financial consequences. The path of the outer scorecard follower is one of guaranteed capital destruction. Let's deconstruct the common mistakes and their disastrous results. The first mistake is buying at the peak. Driven by envy and social proof, the 99% investor typically enters the mania late in the game, after most of the gains have already been made. They buy not because the asset is cheap, but precisely because it is expensive. The high price is, in their mind, validation of its quality. They are buying at the point of maximum financial risk. Consider an investor who bought Pets.com in late 1999. The narrative was compelling, bringing the pet supply industry online. The company had a famous sock puppet mascot and a Super Bowl ad. The social proof was immense, but the business itself was hemorrhaging cash, spending lavishly on marketing to acquire customers at a cost far greater than their lifetime value. The investor who ignored the fundamentals and bought the story would have paid a premium price, When the company went bankrupt less than a year after its IPO, their entire investment was wiped out. It went to zero. This is not just a loss, it is a permanent impairment of capital. The second mistake is the use of leverage. In the throes of a bubble, overconfidence reigns supreme. Investors who have seen their initial stakes double or triple often decide to amplify their returns by borrowing money to buy more. They take out margin loans or home equity loans, convinced they have found a foolproof way to get rich quick. This is financial dynamite. When the bubble bursts, leverage works in reverse, amplifying losses just as it amplified gains. A 50% drop in the stock's value can result in a 100% loss for the leveraged investor, along with a margin call from their broker, forcing them to sell other assets at fire sale prices to cover their debts. This is how bubbles turn market downturns into personal financial ruin, leading to bankruptcies and foreclosures. The third mistake is overconcentration. The outer scorecard investor, convinced they have found the next big thing, often bets the farm on a single stock or a handful of stocks in the same hot sector. They abandon the fundamental principle of diversification. While concentration can build wealth, extreme concentration in an area you don't understand, at the peak of a speculative frenzy, is a recipe for disaster. When the tech bubble burst, many investors had 80, 90, or even 100% of their net worth tied up in technology stocks. When the sector collapsed, their life savings collapsed with it. There was no other part of their portfolio to cushion the blow. Their failure was total. The fourth mistake, and perhaps the most insidious, is what the experience does to their long-term investor psychology. After being so badly burned, the outer scorecard investor often concludes that investing is gambling and the stock market is rigged. They become permanently risk-averse, selling everything at the bottom and retreating to the perceived safety of cash or low-yielding bonds. This means they not only suffer the full pain of the crash, but they also completely miss the subsequent recovery, which is where generational wealth is often made. Their fear, born from the trauma of the bubble, prevents them from participating in the long-term growth of the economy. They are locked out of the greatest wealth creation engine in modern history because they played the game foolishly once and vowed never to play again. The contrast with the inner scorecard investor, like Buffett, is stark. By refusing to participate in the mania, they not only avoid all of these catastrophic mistakes, but they also put themselves in a position of incredible strength. Their portfolio is not impaired. They are not dealing with margin calls. Most importantly, they are holding cash, the one asset that becomes incredibly valuable during a crisis. Their emotional state is one of calm and opportunity, not fear and regret. They are the ones with the financial and psychological capital to act when the blood is in the streets. The direct financial connection of resisting the outer scorecard during a bubble is twofold. First, there is the immense wealth that is preserved by avoiding the crash. But second, and more powerfully, is the incredible wealth that is created by being able to invest in the aftermath. A market crash is a massive, sentiment-driven repricing of assets. It is the moment when Mr. Market shifts from euphoria to despair, offering to sell you wonderful businesses at absurdly low prices. The inner scorecard investor, having patiently sat out the party, now has the opportunity to deploy capital at the point of maximum financial opportunity. Following the dot-com bust, while the Nasdaq was still in freefall, the effects of the September 11th attacks and a recession created a climate of extreme fear. This is when Buffett, a master of contrarian investing, began to find opportunities. His inner scorecard told him that while market sentiment was terrible, many excellent businesses with durable moats were now on sale. He started buying. He invested in companies that were temporarily beaten down but had long-term staying power. This discipline of avoiding the bubble and then aggressively investing in the bust is what truly separates the great investor from the average. The financial impact is staggering. Let's imagine two investors in 1999, each with $1 million. Investor A, the outer scorecard follower, gets swept up in the dot-com mania. They invest their entire million in a popular tech fund at the peak. By the end of 2002, their portfolio is worth maybe $200,000, an 80% loss. Investor B, the inner scorecard follower, finds nothing to buy at reasonable prices in 1999 and holds their $1 million in cash and short-term bonds. They endure the criticism and watch from the sidelines. Then, in the depths of the 2002 bear market, they invest their $1 million into a diversified portfolio of solid, blue-chip companies now trading at deep discounts. Over the next decade, Investor A is just trying to get back to even. It will take a 400% gain just to recover their initial capital. Investor B, on the other hand, bought at the bottom. Their portfolio experiences the full force of the market recovery, compounding from a low base. By 2012, Investor A might have finally seen their portfolio claw its way back to $1 million, a 0% return over 13 years. Investor B, however, could easily have a portfolio worth $3 or $4 million. The difference in their financial destinies is not due to a difference in intelligence, but a difference in temperament and process. It is the direct, quantifiable result of adhering to an inner scorecard. This ability to sidestep the mania and exploit the subsequent panic is not a one-time trick. It is the core mechanism of contrarian investing and long-term wealth creation. It is the ultimate financial advantage conferred by developing the courage to be lonely, to trust your own work, and to live by your own standards no matter how loudly the crowd screams. The ultimate application of the inner scorecard is not just avoiding stupidity, it's about having the courage to act intelligently when everyone else is paralyzed by fear. This is the heart of contrarian investing. It's one thing to sit out a bubble, it's another thing entirely to run into the burning building when everyone else is sprinting out. This requires a level of conviction that can only come from a deeply ingrained inner scorecard. The foundational anecdote for this courage is not from the dot-com bust, but from an even greater period of turmoil, the global financial crisis of 2008. In September of that year, the world's financial system was on the brink of collapse. Lehman Brothers had filed for bankruptcy, the largest in U.S. history. AIG, the world's largest insurer, had been bailed out by the government. The credit markets were frozen solid. There was a palpable, genuine fear that the entire economic system could unravel. The Dow Jones Industrial Average was in freefall. The headlines were apocalyptic. The outer scorecard was not just flashing red. It was screaming, "Sell everything, hoard canned goods, and head for the hills." In this moment of maximum fear, Warren Buffett did something extraordinary. He started buying. On September 23, 2008, he announced that Berkshire Hathaway would invest $5 billion in the investment bank Goldman Sachs. This was not a common stock purchase. It was a special deal for preferred stock that paid a handsome 10% dividend, and it came with warrants to buy common stock at a fixed price. Goldman Sachs was at the very epicenter of the crisis. To many, it looked like Buffett was catching a falling knife, throwing good money after bad into a sector that seemed destined for oblivion. The public reaction was one of shock and disbelief. Why would the famously cautious Oracle of Omaha invest in a Wall Street investment bank at the height of the worst financial crisis since the Great Depression? The answer lies in his inner scorecard. Buffett was not looking at the terrifying headlines or the plunging stock charts. He was looking at the underlying business and the unique circumstances. He had done his own market analysis. He reasoned that Goldman Sachs was a premier franchise with immense talent and a global brand. He also reasoned that the United States government would not, and could not, allow its entire financial system to collapse. He was making a bet on the long-term resilience of the American economy itself. As he later said, "We're buying America." His decision was based on his own principles: be greedy when others are fearful. He saw fear as the friend of the long-term investor, as it created bargain prices for excellent assets. His inner scorecard told him this was a rare opportunity to acquire a piece of a world-class business on exceptionally favorable terms. His $5 billion investment was a massive vote of confidence when confidence was the scarcest commodity in the world. But he wasn't done. Just a few weeks later, he published an op-ed in the New York Times titled, "Buy American I Am." In it, he laid out his simple thesis. The long-term prospects for American businesses were excellent, but their prices in the short term were depressed by fear. He explicitly stated that he was moving his personal cash reserves into U.S. stocks. He was publicly signaling his actions, following his own advice. Then, as the crisis continued, he made another landmark investment, providing $3 billion to General Electric. And later, in 2011, when fears of a double-dip recession were swirling, he made a similar $5 billion investment in Bank of America. Each of these investments was a masterclass in contrarian thinking. They were made at moments of extreme pessimism, when the outer scorecard was screaming, "Danger!" But Buffett's inner scorecard, based on his deep understanding of business value and his long-term perspective, told him it was a moment of opportunity. The results were spectacular. Berkshire Hathaway made billions of dollars from these crisis-era investments. The Goldman Sachs deal alone netted Berkshire a profit of over $3 billion. These were not just successful trades, they were defining moments that cemented his legacy. They demonstrated that the inner scorecard is not a passive, defensive tool for just avoiding mistakes. It is an active, offensive weapon for capitalizing on the mistakes of others. It provides the intellectual and emotional fortitude to make bold, decisive moves when the potential for reward is at its absolute highest, precisely because fear is also at its peak. This is the pinnacle of independent thinking. The courage to act as a contrarian in the face of overwhelming fear is not a personality trait. It is a psychological skill, one that is built upon a deep understanding of specific behavioral finance principles. The primary bias that a contrarian investor overcomes is myopic loss aversion. This is the human tendency to feel the pain of short-term losses so intensely that it overrides any rational long-term perspective. In a market crash, investors are bombarded with negative feedback. Every time they look at their portfolio, they see red. This constant stream of painful stimuli triggers a primitive fight-or-flight response. The instinct is to flee, to sell, to make the pain stop. The contrarian investor has trained themselves to zoom out. They understand that market fluctuations are not the same as fundamental business deterioration. They are able to look at a 30% drop in a stock price, not as a loss, but as a sale. Their inner scorecard, anchored to their own calculation of a company's intrinsic value, provides a stable frame of reference in a sea of volatility. When the price drops well below that intrinsic value, it triggers a buy signal in their brain, not a panic signal. This is a learned response, not an innate one. Another crucial principle is what's known as the availability heuristic. This is our tendency to overestimate the likelihood of events that are more recent, more frequent, and more emotionally charged. During a financial crisis, the media is saturated with stories of bankruptcy, unemployment, and economic collapse. These vivid, terrifying stories are readily available to our minds. As a result, we begin to believe that a catastrophic outcome is not just possible, but probable. We lose perspective on the long-term statistical reality, which is that economies and markets are remarkably resilient and have always recovered from past crises. Buffett's 2008 op-ed was a direct assault on the availability heuristic. He was reminding people of the bigger picture, the longer-term trend of American prosperity, to counteract the emotionally overwhelming, but statistically less significant, short-term panic. The contrarian also masters the art of fighting confirmation bias in reverse. Most people, when they are scared, will seek out information that confirms their fear. They will read the gloomiest articles and listen to the most bearish pundits. This creates a feedback loop of negativity. The contrarian actively seeks out disconfirming evidence. They ask the critical question, what if the consensus is wrong? What would have to be true for this to be an incredible buying opportunity? They force themselves to analyze the situation from the opposite perspective. They read the financial statements of the companies being sold off, looking for signs of underlying strength that the market is ignoring. They are not looking for confirmation of the panic. They are looking for evidence of resilience. Finally, the contrarian investor understands the concept of time arbitrage. They recognize that most market participants, particularly institutional investors like hedge funds and mutual funds, have a very short time horizon. They are judged on quarterly or annual performance. This forces them to sell during a panic, even if they know the assets are cheap, because they cannot afford the short-term pain of underperformance. The individual retail investor has a massive structural advantage here. They have no one to report to but themselves. They can afford to have a 5, 10, or even 20-year time horizon. They can buy a beaten-down, quality asset and wait patiently for years for its value to be recognized. This ability to trade a willingness to endure short-term volatility for the probability of high long-term returns is one of the most powerful tools available to the non-professional investor. By understanding these psychological principles, the contrarian investor realizes that a market panic is not a random event. It is a predictable, recurring failure of collective human psychology. And by having a pre-prepared mental framework, the inner scorecard, they can exploit that failure for their own gain, turning the market's greatest weakness into their greatest strength. Building the courage and the process to be a successful contrarian investor is a deliberate act of mental engineering. It is not enough to simply decide you will be greedy when others are fearful. You need a concrete blueprint for action. Here is a step-by-step mental model for applying the inner scorecard during a market panic. The first step, which must be completed long before a crisis hits, is to create a panic buy list. This is a curated list of wonderful businesses that you have already researched, valued, and understand deeply. These are companies with strong balance sheets, durable competitive moats, and excellent management. The only reason you don't own them is that their stock prices are currently too high. For each company on your list, you will set a series of dream prices, the price points at which you would be ecstatic to buy them, representing a significant margin of safety below your calculated intrinsic value. For example, I will buy company X at $80, and I will buy more at $70, and I will back up the truck if it hits $60. This pre-planning does two crucial things. It removes the need for frantic research and decision-making during the chaos of a crash, and it emotionally pre-commits you to taking action. When the market starts to fall, you are not thinking, "What should I do?" You are thinking, "Are any of the companies on my list hitting my price?" The second step is to have a dedicated source of panic capital. This is cash or cash equivalents that you have set aside specifically for deployment during a market downturn. It is dry powder. This is psychologically critical. If all your money is already invested, a market crash just feels painful. But if you have a significant cash position, a market crash starts to feel like an opportunity. It reframes the entire event. The existence of this capital turns you from a potential victim into a potential predator. When setting up your overall wealth management strategy, you should consciously decide on a target cash allocation that you will maintain for exactly this purpose. The third step is to implement a scaled buying strategy. It is impossible to know where the exact bottom of a market will be. Trying to time it perfectly is a fool's errand. A much more effective approach is to buy in tranches on the way down. Your panic buy list has already defined your price levels. As the stock hits your first dream price, you deploy a portion of your panic capital, say 1/3 of your intended full position. If it continues to fall to your second price point, you deploy another third. If it reaches your back up the truck price, you deploy the final third. This systematic approach removes the paralysis of trying to pick the perfect moment. It ensures you start building a position at attractive prices, and it gives you the psychological benefit of being happy if the stock goes down even further, as it allows you to buy more at an even better price. The fourth step is to practice an information quarantine during the panic. While it's important to stay informed about the facts, you must aggressively filter out the emotional noise. This means avoiding the cable news fear-mongering and the panicked chatter on social media. Stick to primary sources, the financial reports of the companies you are buying, and the official announcements from government bodies like the Federal Reserve. Remind yourself that the media's job is to sell drama, not to provide sober investment advice. Reread your own investment constitution and classic texts like The Intelligent Investor to reinforce your rational framework and drown out the noise of the herd. The fifth and final step is to review the aftermath. After every market crisis, once the dust has settled, conduct a post-mortem on your own performance. Did you follow your plan? Did you deploy your capital when your price points were hit? Or did you let fear paralyze you? What could you have done better? This process of review and reflection is how you learn and improve. It strengthens your conviction for the next crisis, which will inevitably come. By seeing the positive results of having acted courageously, or by analyzing the cost of having failed to act, you are hardening your inner scorecard for the future. This 5-step blueprint transforms contrarian investing from a vague idea into a disciplined, repeatable process. It is the operational manual for the courageous investor, the practical guide to turning market fear into personal financial freedom. The path of the 99% during a market panic is a tragedy in 3 acts. It is the mirror image of the contrarian's journey, and it perfectly illustrates the disastrous consequences of living by an outer scorecard when fear takes hold. Act 1 is denial. In the initial stages of a downturn, the average investor, who likely bought near the highs, is in a state of denial. They tell themselves it's just a healthy correction, or a temporary dip. They might even buy the dip, not based on any valuation work, but simply because they are anchored to the recent high price and assume it will quickly return there. They see the falling prices as an anomaly, an error that the market will soon correct. Their emotional state is one of nervous optimism, clinging to the hope that the party isn't over. Act 2 is panic. As the downturn accelerates and becomes a full-blown crash, denial gives way to raw, unadulterated fear. The headlines are terrifying. Their portfolio is bleeding value daily. The stories of economic ruin are everywhere. Their previous optimism now looks naive and foolish. Because their initial purchase was based on flimsy reasoning, a tip, a story, momentum, there is no foundation of conviction to support them. All they know is that they are losing money, and the pain is becoming unbearable. This is when the most destructive decisions are made. They capitulate. They sell everything, or at least their most beaten-down stocks, to, quote, stop the bleeding. Their primary motivation is to end the psychological pain. They are not selling based on a rational assessment of the company's future prospects, but on a visceral, emotional need to escape. The irony is that they are often selling at the point of maximum pessimism, right when the assets are the cheapest and the future returns are likely to be the highest. They are locking in their losses and turning a temporary paper decline into a permanent loss of capital. Act 3 is despair and regret. After selling at the bottom, the investor retreats to the sidelines, traumatized by the experience. As the market inevitably finds its footing and begins a slow, grinding recovery, they are too scared to get back in. They view the initial rally with suspicion, calling it a, quote, dead cat bounce. They wait for more certainty, for the economy to be clearly recovering, for the headlines to turn positive. The problem is that by the time the certainty arrives, the market has already recovered a huge portion of its losses. The easy money has been made. They have missed the most profitable part of the new bull market. Eventually, often years later, when the market is hitting new highs and the euphoria has returned, their envy and fear of missing out will overcome their fear of losing, and they will finally get back in, often buying near the next market peak. They have successfully executed the perfect anti-investment strategy: buy high, sell low. This cycle is the single greatest destroyer of wealth for the retail investor. It is the direct result of having no internal anchor, no inner scorecard. Their emotional state is entirely dictated by the market's gyrations and the surrounding media narrative. They are a cork tossed on a stormy sea, and their financial destination is shipwreck. This path ensures that they will experience all of the market's downside and miss most of its upside, a surefire recipe for long-term failure. The direct financial connection between being a contrarian and building wealth is the most powerful force in all of investing. It is the engine of compounding on steroids. Let's quantify the impact of buying during a panic versus selling. Consider the S&P 500 during the 2008 crisis. The market peaked in October 2007 and bottomed in March 2009. An investor who panicked and sold everything at the bottom in March 2009 and put their money in cash would have locked in a loss of over 50%. For the next 5 years, their money would have earned close to zero interest. By March 2014, their initial capital would still be down by roughly 50%. Now consider the contrarian investor. They had their panic buy list and their panic capital ready. They saw the crash not as a disaster, but as the sale of a lifetime. Let's say they invested their capital in a simple S&P 500 index fund in March 2009. Over the next 5 years, from March 2009 to March 2014, the S&P 500, including dividends, produced a total return of approximately 200%. The initial capital would have tripled, so after 5 years, the panicking seller is still down 50%, while the courageous buyer is up 200%. On an initial investment of $100,000, the seller now has $50,000, while the buyer has $300,000. That is a $250,000 difference in outcome based on a single set of decisions made during a few terrifying months. This is the magnitude of the financial swing. This is not just about the return on a single investment. It impacts the entire trajectory of one's financial life. That $250,000 difference, compounded over subsequent decades, can easily become a multi-million-dollar gap in net worth by the time of retirement. This is the true meaning of financial freedom. Furthermore, the act of successfully navigating a crisis and profiting from it has a profound effect on the investor's balance sheet and income statement for years to come. By acquiring assets at deeply depressed prices, the contrarian investor locks in a much higher dividend yield. If a stock that normally trades at $100 and pays a $3 dividend is bought during a panic at $50, the investor's yield on their cost is not 3%, but 6%. This dramatically increases the passive income generated by their portfolio, providing a stream of cash that can be reinvested at similarly attractive prices, creating a virtuous cycle of wealth creation. On the balance sheet, the assets are acquired at a cost basis that is so low it provides an enormous cushion against future volatility. This structural advantage, built during a brief period of market insanity, pays dividends, both literally and figuratively, for a lifetime. This is why Buffett has said that a market downturn is the best thing that can happen to a true long-term investor. It's the rare opportunity to purchase the future earning power of great American businesses at clearance prices. The inner scorecard is what provides the key to unlock that opportunity. It is the mental tool that allows you to separate yourself from the terrified herd and act with clarity and conviction when it matters most. The financial reward for this discipline is not just a slightly better return. It is a fundamentally different class of wealth, built not by chance, but by design. While the inner scorecard is the bedrock of a superior investment strategy, its principles extend far beyond the stock market. To truly internalize this mindset is to apply it to all major decisions, particularly in business and career. This is the transition from a stock picker's mentality to a CEO mindset, a way of thinking that is essential for entrepreneurs and leaders who aim to build enduring value. The foundational anecdote for this expansion of the principle comes from one of Buffett and Munger's most important acquisitions, See's Candies. In 1972, Berkshire Hathaway had the opportunity to buy the beloved California-based chocolate company. At the time, Buffett was still heavily influenced by the cigar butt investing of his mentor, Ben Graham. He was focused almost exclusively on buying statistically cheap assets, paying as little as possible for a company's tangible book value. See's Candies presented a dilemma. The asking price was $30 million, but the company's tangible assets, the factories, the stores, the inventory, were only worth about $8 million. From a pure Graham perspective, this was a terrible deal. Paying a $22 million premium for something intangible, like a brand name, was anathema to the classic value investing playbook. The outer scorecard of the time at least within the small world of value investing, would have judged this purchase as a foolish departure from a winning formula. Many of Buffett's contemporaries would have walked away without a second thought. But this is where Charlie Munger played a pivotal role in expanding Buffett's inner scorecard. Munger convinced Buffett to think not just as an investor buying a stock, but as a business owner buying a whole company. He argued that See's possessed an enormous and unrecorded asset on its balance sheet, a powerful, durable, competitive moat. For decades, See's had built a fanatical customer following based on quality and nostalgia. Customers in California had a deep emotional connection to the brand, forged over holidays, birthdays, and special occasions. This gave See's pricing power. They could raise the price of their chocolates every year without losing customers. Because the purchase was driven by emotion and tradition, not just price, this brand loyalty was a powerful, albeit intangible, economic asset. Buffett and Munger had a choice. They could stick to their old, comfortable inner scorecard based purely on tangible assets, or they could evolve it to include a more sophisticated understanding of business quality. They chose to evolve. They made a decision based on their own first-hand analysis of the business's competitive position and its future earning power, rather than on a rigid, inherited formula. They paid the $25 million that the sellers ultimately accepted. This decision was a watershed moment for Berkshire Hathaway. See's Candies went on to generate cumulative pre-tax earnings for Berkshire of over $2 billion, requiring very little additional capital investment. It became the prototype for the kind of business Buffett would look for from then on, a company with a strong brand, pricing power, and loyal customers, a true franchise. The lesson was profound. A CEO, or an entrepreneur, cannot build a great business by only looking at what is quantifiable on a spreadsheet. They must understand the intangible drivers of value: brand, culture, customer loyalty, and competitive dynamics. The See's acquisition was an executive decision made by trusting their own judgment about the quality of a business, even when it violated the conventional wisdom of their own discipline. It was the inner scorecard applied to corporate strategy. It taught them that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This shift in mindset, from cigar butts to franchises, is what propelled Berkshire from a small collection of statistical bargains into the global powerhouse it is today. It was a direct result of applying the principle of independent thinking not just to the market, but to the art of business itself. The CEO mindset, and that of the successful entrepreneur, is fundamentally about resisting a different kind of outer scorecard. Instead of market opinion, the pressures come from industry trends, competitor actions, and short-term performance metrics. The psychological principles that trap the average investor are the same ones that trap the average executive. Social proof in the business world manifests as chasing the fad. When a new management theory, technology, or business model becomes popular, there is immense pressure for every company to adopt it, regardless of whether it fits their specific strategy or culture. CEOs who ignore the trend are seen as dinosaurs, just as Buffett was during the dot-com boom. Think of the pressure on every retailer to have an online strategy in the early 2000s, or on every company to have an AI strategy today. A leader with an inner scorecard doesn't ask, "Is everyone else doing this?" They ask, "How does this genuinely create long-term value for our specific customers and strengthen our unique competitive advantages?" They are willing to be lonely and focused rather than popular and distracted. Authority bias also runs rampant in the corporate world. High-priced consultants and industry analysts often dictate corporate strategy. They come armed with impressive slideshows and industry benchmarks, telling companies what they must do to remain competitive. A leader with a weak inner scorecard will outsource their strategic thinking to these outside experts, often leading to generic, cookie-cutter strategies that erode the company's unique identity. A great CEO, however, uses consultants for data and perspective, but retains the final authority on strategic decision-making. Their inner scorecard, based on a deep, almost cellular-level understanding of their own business and customers, is the ultimate arbiter. Loss aversion is another major trap for executives. It often manifests as a, quote, fear of cannibalization, A company with a successful, profitable legacy product may see a disruptive new technology on the horizon, but be terrified to invest in it for fear of hurting the sales of their existing cash cow. Kodak, for example, famously invented the digital camera but was slow to embrace it, afraid of cannibalizing its immensely profitable film business. A leader with an inner scorecard is willing to sacrifice today's profits for a dominant position in the future. They understand that if they don't cannibalize themselves, a competitor will. This requires making decisions that will cause short-term pain on the income statement, a big negative on the outer scorecard, for the sake of long-term survival and growth. Finally, the overconfidence that comes from past success is a classic CEO pitfall. A company that has dominated its industry for years can become arrogant and complacent. The leadership team starts to believe their own press clippings and stops listening to customers or paying attention to upstart competitors. Their inner scorecard becomes corrupted by ego. The business world is littered with the corpses of once great companies that fell victim to this hubris. From Blockbuster to Nokia, a leader who maintains a healthy sense of paranoia, who constantly questions their own assumptions, and whose inner scorecard is based on a brutal honesty about their own vulnerabilities, is the one who builds an institution that lasts. The CEO or entrepreneur who consciously cultivates an inner scorecard is playing a different game. They are not focused on managing quarterly earnings to please Wall Street analysts, the ultimate outer scorecard. They are focused on making a series of rational decisions designed to widen their company's competitive moat over the next decade. This often means making investments in research and development, customer service, or employee culture that won't pay off immediately, but will build a stronger, more resilient enterprise in the long run. It is the application of long-term thinking and independent judgment to the art of building a business. For the entrepreneur or the executive who wants to cultivate this CEO mindset, the blueprint is a direct parallel to the investor's model, but it is applied to business strategy and leadership. It involves a systematic process of codifying principles, deep analysis, strategic allocation, and disciplined patience. The first step is to codify your corporate constitution. This is the mission, vision, and values of your organization. But it must be more than just platitudes on a wall. It must be a set of clear, actionable principles that will guide every major decision. What business are we really in? What is our unique value proposition to our customers? What are the non-negotiable principles of how we will operate? For example, a company might have a constitutional principle that states, "We will never sacrifice customer trust for short-term profit." This written principle then becomes the inner scorecard against which all new initiatives are measured. When a manager proposes a plan to cut corners on quality to boost quarterly margins, the CEO can point to the Constitution and reject it, not as a matter of opinion, but as a violation of their core identity. The second step is deep, continuous business research. A great CEO is the chief learning officer. They must understand their industry, competitors, and customers better than anyone else. This doesn't mean just reading analyst reports. It means spending time with customers, visiting the front lines of their own operations, and talking to employees at all levels. It means developing an intuitive feel for the business that cannot be captured in a financial model. This deep knowledge is the foundation of conviction. When a competitor makes a splashy move, the CEO with this deep understanding can calmly assess whether it is a genuine threat or just noise, allowing them to respond strategically rather than react emotionally. The third step is strategic capital allocation. A CEO's most important job is deciding where to deploy the company's resources, its money, and its people. This is the corporate equivalent of an investor's valuation and buying process. Every project, every potential acquisition, every new hire is an investment. The CEO with an inner scorecard evaluates these opportunities not based on which is most popular or politically expedient, but on which has the highest expected long-term return on investment, measured against the principles of their corporate constitution. This requires the courage to say no far more often than yes. It means starving the projects that are merely good in order to pour resources into the handful of opportunities that could be truly great. This disciplined allocation is the primary driver of long-term value creation in any business. The final step is strategic patience, the corporate version of inaction. Once a long-term strategy is set, a great leader must have the discipline to stick with it, giving it time to work. The outer scorecard of the business world is constantly demanding new initiatives, reorganizations, and pivots. There is immense pressure to always be seen as doing something. But often, the most powerful strategic move is to patiently and relentlessly execute on a proven model, making small, incremental improvements every day. This requires resisting the urge to chase every new trend or react to every competitor's move. It's about having the quiet confidence that your current path is the right one and giving your strategy the time it needs to compound. This four-part blueprint, constitutional principles, deep research, strategic allocation, and strategic patience, is the operating system for the CEO mindset. It allows a leader to tune out the short-term noise and focus on the long-term signals. It is how you build a business, like See's Candies, that becomes more valuable every year, immune to the fads and panics that consume the competition. It is the ultimate application of independent thinking in the world of commerce. The path of the 99% of leaders and entrepreneurs is a familiar one. It is the path of the reactive, trend-chasing manager, not the proactive, value-building CEO. Their decisions are governed by an external scorecard of industry buzz, competitor moves, and quarterly results. The first mistake is strategy by bestseller. These leaders chase the latest management fad. 1 year, it's total quality management. The next, it's Six Sigma, then Agile, then disruption. They impose these top-down initiatives on their organizations, without a deep understanding of whether they fit the company's unique culture or strategic needs. The result is a cycle of cynicism and initiative fatigue among employees, a lot of wasted resources, and very little lasting impact on the business's performance. They are constantly changing direction, leaving their teams confused and demoralized. The second mistake is competitor mimicry. Instead of developing a unique strategy based on their own strengths, they simply copy what their most successful competitor is doing. If the market leader launches a new product, they rush to launch a Me Too version. If a competitor opens a new sales channel, they do the same. This guarantees they will always be one step behind, fighting for scraps in a market defined by someone else. They are playing not to win, but to not lose. This reactive posture erodes any unique advantage they might have had, and often leads to brutal price wars that destroy profitability for the entire industry. The third mistake is tyranny of the urgent. These leaders spend their days bouncing from one fire to the next, consumed by short-term problems and crises. They are addicted to the adrenaline of being busy. They have no time for the deep thinking and long-term planning that are the true work of leadership. As a result, the business never develops a clear strategic direction. It drifts, reacting to the demands of the day, but never making progress toward a meaningful destination. They mistake activity for achievement. The consequence of this path is the creation of a fragile, generic, and low-margin business. It has no durable competitive advantage, no unique identity, and no loyal customer base. It is vulnerable to every economic downturn and every new competitive threat. The employees are disengaged because they don't see a compelling long-term vision. The customers are disloyal because they are only there for the price. The leader, for all their frantic activity, ends up building a business that is perpetually struggling for survival, a fair company that will never be a wonderful company. This is the direct result of leading from an outer scorecard, of allowing the pressures of the outside world to dictate the internal agenda. The direct financial connection between a CEO mindset rooted in an inner scorecard and the financial performance of a business is staggering. It is the difference between creating a company that merely survives and creating one that becomes a compounding machine for its owners. A company led by this mindset will exhibit specific, measurable financial characteristics. First, it will have consistently higher profit margins than its competitors. This is a direct result of building a genuine moat. Because the company has a strong brand or a unique product, it doesn't have to compete on price alone. It has pricing power. Like See's Candies, it can raise its prices year after year, and that incremental revenue drops almost entirely to the bottom line, boosting the company's income statement. The reactive mimicker competitor is forced to constantly discount, eroding their own margins. Second, the business will generate a high and sustainable return on invested capital, ROIC. A disciplined CEO who is a master of capital allocation will only invest in projects that promise a high rate of return. They avoid vanity projects and wasteful spending. This efficiency shows up directly on the balance sheet and cash flow statement. The company generates more and more profit from a smaller and smaller base of capital, creating a surplus of free cash flow. This free cash flow is the ultimate measure of a company's financial health and the source of all real shareholder value. It can be used to pay dividends, buy back shares, or reinvest in new high-return projects, creating a powerful compounding effect. Third, the company's balance sheet will be a fortress. A leader with a long-term perspective understands that downturns are inevitable. They will run the business with a conservative amount of debt, ensuring that the company can not only survive a recession, but can actually use its financial strength to acquire weaker competitors at bargain prices. The outer scorecard leader, focused on goosing short-term returns, might pile on debt to fund risky expansion, leaving the company dangerously exposed when the economy turns. The tangible financial advantage is resilience and opportunism. The company can play offense when everyone else is playing defense. Finally, the ultimate financial manifestation is a steadily increasing intrinsic business value. While the stock price may fluctuate, a company led by the CEO mindset will become demonstrably more valuable each year. Its earning power will grow, its moat will widen, and its financial position will strengthen. For an entrepreneur who owns the business, this translates directly into a massive increase in personal net worth. For a public company CEO, it translates into superior long-term stock performance for their shareholders. This is not a matter of luck. It is the direct, quantifiable financial output of a leadership philosophy based on independent thinking, long-term focus, and an unwavering commitment to an internal set of principles, the inner scorecard. Ultimately, the practice of living by an inner scorecard is about more than just beating the market or building a successful business. It is about defining success on your own terms and achieving a state of genuine financial freedom. This final pillar connects the entire philosophy to its ultimate purpose: a life of independence, resilience, and personal fulfillment. The most profound foundational anecdote for this is not an investment or an acquisition, but Warren Buffett's decision regarding his own vast fortune. For decades, the outer scorecard of society assumed that Buffett would, like most magnates before him, create a dynasty, passing his immense wealth down through his family to be managed by generations of Buffetts. This was the conventional model of success for the ultra-wealthy. It was the expected, celebrated path. In 2006, Buffett announced a decision that stunned the world of philanthropy and wealth management. He pledged to give away virtually his entire fortune, at the time over $30 billion, to charity, with the majority going to the Bill and Melinda Gates Foundation. He was not creating a grand Buffett Foundation to memorialize his own name. He was not endowing his family for centuries to come. He was giving his money to an existing, effective organization run by people he trusted, where he believed it could have the greatest impact on humanity's biggest problems. In his letter explaining the decision, he laid out his reasoning with crystal clarity. He argued that massive, dynastic wealth was anti-meritocratic and bad for society. He famously said he wanted to give his children enough money so that they would feel they could do anything, but not so much that they could do nothing. He believed that his fortune, which he viewed as the result of living in a remarkable society, should be returned to that society to address its needs. This decision is the ultimate expression of an inner scorecard. It was a complete and total rejection of the outer scorecard's definition of legacy and success. The conventional view says success is measured by the size of the estate you pass on. Buffett's inner scorecard defines success as the utility that his capital could provide to others. The decision was not based on what would bring him the most public acclaim or what was expected of a man in his position. It was based on a deeply held, personal, and logical set of principles about wealth, family, and society. He had spent a lifetime compounding capital, and now he was applying the same rational, unemotional, and long-term thinking to the process of distributing it. He was looking for the highest possible return on investment in terms of human well-being. This act redefines the entire concept of financial freedom. For most people, financial freedom is simply about having enough money to not have to work. For Buffett, it was something more profound. It was the freedom to allocate all of his resources, his time, his energy, and his capital according to his own values, completely unconstrained by the opinions or expectations of others. His wealth gave him the ability to make a decision of this magnitude, but it was his inner scorecard that gave him the clarity and conviction to do so. It shows that the end goal of this entire mindset is not just to accumulate a large number, but to have the independence of thought to use that accumulation for a purpose that you, and you alone, define as worthy. The ultimate measure of success, whether in life or in finance, is a deeply psychological question. The inner scorecard provides a framework for achieving a state of being that behavioral scientists might call eudaimonic well-being. This is a sense of fulfillment that comes not from fleeting pleasures, hedonic well-being, but from living a life of purpose, virtue, and authenticity. It is the feeling of being true to oneself. The psychological principle at play here is self-determination theory, which posits that human beings have three innate psychological needs: autonomy, competence, and relatedness. A life guided by an inner scorecard directly satisfies these needs. Autonomy is the need to feel in control of one's own behaviors and goals. By making decisions based on your own research and principles, you are exercising the ultimate form of intellectual and financial autonomy. You are the author of your own choices, not a follower of the crowd. This sense of agency is a powerful source of psychological well-being. Competence is the need to feel effective and capable. The process of building an inner scorecard, the deep research, the valuation, the patient execution, is a journey of mastery. As you get better at it, as you see the positive results of your disciplined process, you build a genuine sense of competence. This is a much more stable and enduring source of self-esteem than the fleeting praise that comes from a lucky stock pick validated by the outer scorecard. Relatedness is the need to feel connected to others. This might seem counterintuitive for a philosophy that emphasizes independent, even lonely, thinking. But the connection here is not with the anonymous crowd, but with a community of like-minded individuals. By living authentically to your own principles, you attract others who share those values. You build deeper, more meaningful relationships based on mutual respect for a shared philosophy of life and investing, rather than superficial connections based on a shared interest in a hot stock. The opposite of this is the hedonic treadmill. People who live by the outer scorecard are constantly chasing the next hit of external validation, the next winning trade, the next promotion, the next luxury purchase. But the pleasure from these achievements is always fleeting. Once they reach one goal, the happiness fades, and they immediately need a new, bigger goal to feel good again. They are running on a treadmill, constantly striving but never arriving at a lasting sense of satisfaction. The inner scorecard breaks this cycle. Because your sense of success is derived from adherence to your process and your principles, it is stable and internally generated. A successful outcome is simply a validation of a good process. An unsuccessful outcome, which will inevitably happen, is an opportunity to learn and refine the process. The source of satisfaction is the journey of mastery itself, not the momentary destinations. This mindset is the ultimate form of emotional control. It creates a state of equanimity. You are not euphoric in bull markets nor despondent in bear markets. You view both with a detached, opportunistic calm. This emotional stability is not only crucial for long-term investment success, it is a cornerstone of a happy and fulfilling life. It is the true financial freedom, not just freedom from financial worry, but freedom from the emotional tyranny of external opinion. The blueprint for achieving this ultimate state of financial and personal freedom is the culmination of everything we have discussed. It is about integrating the inner scorecard so deeply that it becomes the default operating system for your life. First, you must define your personal victory conditions. Sit down and write out, with complete honesty, what a successful life looks like to you, independent of anyone else's expectations. What do you truly value? Is it time with your family? The freedom to pursue a creative passion? The ability to contribute to a cause you believe in? Be specific. Your financial goals should flow from these life goals, not the other way around. Your money should be a tool to build the life you have defined, not an end in itself. Your inner scorecard's ultimate purpose is to measure your progress toward these personal victory conditions. Second, you must build a resilience ritual. This is a regular practice designed to strengthen your internal focus and detach from external noise. It could be a daily practice of journaling, where you review your decisions and reaffirm your principles. It could be meditation, which trains the mind to observe thoughts and emotions without being controlled by them. It could be a weekly digital Sabbath, where you completely unplug from all media for 24 hours to clear your head and reconnect with your own thoughts. This ritual is your training ground for maintaining emotional control in a world designed to hijack it. Third, you must teach to learn. The best way to deeply internalize a set of principles is to try to explain them to someone else. Mentor a younger investor. Write a blog about your investment philosophy. Have deep conversations with your rationality partner. The act of articulating your thought process forces you to clarify it and exposes any weaknesses. It transforms you from a passive recipient of a philosophy into an active practitioner and champion of it. Fourth, you must practice voluntary hardship. This is an old Stoic technique for building psychological resilience. Periodically, you deliberately expose yourself to a small, controlled dose of discomfort. It could be as simple as taking cold showers for a week or fasting for a day. This practice teaches your mind that you can withstand discomfort and that your well-being is not dependent on a constant state of ease. It builds an anti-fragile character, one that grows stronger from stress and adversity. This is crucial for an investor who must be able to withstand the psychological discomfort of a bear market. Finally, you must conduct a legacy review annually. This is a moment to step back and look at the big picture. Are you allocating your most precious resource, your time, in accordance with your deepest values? Is the wealth you are building aligned with the legacy you want to leave? This is not about the number on your balance sheet, but about the impact you are having on the people and causes you care about. This review ensures that your journey of wealth creation remains tethered to a sense of purpose. This is the final blueprint. It is about taking the core concept of the inner scorecard and expanding it into a complete philosophy for a well-lived life. It is a plan for building not just a great portfolio, but a great character. It is the path to achieving a form of wealth that cannot be measured in dollars alone, the wealth of a life lived with purpose, conviction, and true independence. The path of the 99%, when viewed through this ultimate lens, is not just a story of poor financial returns, but one of a quiet, unfulfilled life. Their measure of success is perpetually outsourced, leaving them with a chronic sense of inadequacy. Their biggest mistake is goal contagion. They don't consciously choose their life goals. They absorb them from their social environment. They pursue the bigger house, the fancier car, the more prestigious job title, not because they have deeply considered whether these things will bring them fulfillment, but because this is what the people around them seem to value. They are climbing a ladder, only to realize decades later that it was leaning against the wrong wall. Their careers and financial decisions are not aligned with their authentic selves, leading to a persistent, low-grade sense of dissatisfaction, even in the midst of material success. Another common failure is the comparison game. Thanks to social media, the outer scorecard is now more powerful and pervasive than ever before. The 99% are constantly comparing their own messy, real life with the curated highlight reels of others. This is a game that is impossible to win and guarantees unhappiness. They are always aware of someone who is richer, more successful, or seemingly happier. This constant comparison breeds envy and anxiety, robbing them of the ability to appreciate their own journey and accomplishments. Their self-worth is fragile, dependent on their perceived rank in a social hierarchy that is both illusory and irrelevant to their own well-being. Finally, they suffer from a purpose deficit. Because their focus is on the accumulation of money and status as ends in themselves, they often fail to connect their efforts to a larger sense of purpose. They work hard, they build wealth, but they lack a compelling why. This is why you see so many stories of people who achieve all the conventional markers of success: wealth, fame, power, only to find themselves feeling empty and lost. They have won the game dictated by the outer scorecard, but they have neglected the needs of their inner selves. The ultimate consequence of this path is a life of quiet desperation. It is a life spent chasing external validation, always feeling one step behind, and never achieving a stable sense of peace or fulfillment. It is the tragedy of sacrificing the authentic for the applauded. It is the profound human cost of living a life dictated by the opinions of others, a life without the anchor of a strong personal inner scorecard. The direct financial connection of this ultimate pillar is the most important of all. It is the concept of enough. An investor guided by an inner scorecard that is aligned with their life goals is capable of knowing when they have enough. They can step off the hedonic treadmill. This is a superpower in a world that is always demanding more. The financial implication is enormous. By defining enough, you are freed from the compulsion to take ever-increasing risks in pursuit of ever-increasing wealth that you don't actually need. You can de-risk your portfolio as you approach your financial freedom number, shifting from aggressive wealth creation to conservative capital preservation. This protects you from the tragic fate of the investor who builds a massive fortune over a lifetime, only to lose a huge chunk of it in a market crash right before retirement, because they were still taking too much risk. Knowing when you have enough allows you to win the game by stopping play. Furthermore, a life of purpose beyond money leads to better financial decisions. When your self-worth is not tied to your net worth, you are far less likely to make ego-driven investment mistakes. You can view your portfolio as a tool to serve your life's purpose, rather than as a reflection of your intelligence. This emotional detachment is the holy grail of investing. It allows you to follow your rational process with greater fidelity, leading to better long-term results. Finally, this mindset unlocks the ultimate dividend that wealth can provide: control over your time. By defining your own success and achieving a state of financial freedom, you buy back your hours, your days, your years. You can redirect the time and energy you once spent on accumulating more money toward the people, projects, and causes that you have identified as truly meaningful. This is the final and most valuable return on investment. The wealth is no longer just a number on a statement. It is converted into a life of freedom, purpose, and autonomy. This is the true financial transformation promised by the inner scorecard. It is not just a method for beating the market. It is a philosophy for winning at the far more important game of life. It delivers a form of riches that money alone can never buy. You have just spent this time investing in the single most powerful mental model in the arsenal of the world's greatest investor. You have absorbed a complete blueprint for rewiring your mind, for shifting your source of validation from the chaotic and unreliable opinion of the crowd to the solid, dependable bedrock of your own principles. This concept of the inner scorecard is not just a theory, it is a practical tool, a cognitive shield that will protect you from the bubbles and panics that wipe out the unprepared. It is the key to independent thinking, the source of emotional control, and the foundation upon which lasting wealth is built. You now possess the framework to move from being a market participant to a market master, from a follower to a leader, from a speculator to a true business owner. But what you have just mastered, as powerful as it is a single crucial node in a much larger network of thinking. Warren Buffett's success is not the result of one mental model, but of a latticework of interconnected models, working in concert to produce extraordinary judgment. The inner scorecard gives you the what, the conviction to act. But it must be connected to other models that govern the how. How you value a business, how you assess management, how you understand competitive advantage. The piece of the map you now hold is invaluable, but it is still just one piece. The video that is now on your screen is not an accident. It has been selected because it contains the next piece of that map. It is the link that connects the principle you just mastered to another, equally critical component of this powerful mental arsenal. To click away now would be like learning how to build a powerful engine but having no chassis to put it in. The journey to becoming an elite thinker, an independent mind capable of achieving true financial freedom, is a continuous ascent. The choice you have right now is simple. You can stop here, with one powerful tool in your belt, or you can choose to continue the climb. You can choose to add the next essential link to your chain of reasoning. The question is not whether you want to watch another video. The question is, who do you want to become? The path forward is right there. Complete your arsenal. Make the choice to continue your ascent.